Well, 2015 is seeing quite the rocky start for the markets. Oil keeps on dropping and staying low. Volatility, oh boy, is it back. And bond yields continue to drop lower and lower. So what is the outlook and how can you manage your risk moving ahead? Here to give us some insight on what they are seeing, we are joined by Andrew Kelvin. He is Senior Fixed Income Strategist at TD Securities, and Paul Gray, he's Director at TD Securities. Thank you so much for joining us.
Our pleasure.
Thank you.
Let's start off with, if you could, just paint a picture for me about what the individual investor can expect from the fixed markets in 2015.
Well, certainly through the early part of the year, we've seen a lot of the major trends from 2014 continue. Oil prices remain very low. There's a lot of concern over Europe. And really outside, certainly North America, there are a lot of questions about sustainability of global growth. However, within North America, some of the recent data points in the United States have been very strong. GDP growth has been well above trend in the most recent quarters. And the U.S. labor market added more jobs in 2014 than it has, at any year since the financial crisis. So
some might argue the quality of those jobs and the wages may not be there, but that's a different discussion.
That's a different discussion.
Okay.
Regardless, it's probably the most favorable economic environment in North America that we've seen in several years, certainly.
Okay. That sounds positive.
Yep.
I'm going to turn now to the second and tell me what you're seeing from the trading perspective. So how do investors feel as positive, perhaps, as that I'll say nascent picture is coming out right now?
On the fixed income side, we don't see investors as positive. We see a lot of people sitting in cash waiting for rates to back up before they invest.
Yeah. And what kinds of things, is it just lower volume as well and just not really seeing enthusiasm in terms of what to do?
Enthusiasm about the market and lower volumes.
Yeah.
Individuals are just staying on the sidelines waiting.
So if we, come back, I mean, you talk about this outlook for the U.S. and this, we've seen a lot of job growth. Investors aren't feeling it right now exactly from a yield perspective in the market. And you talk about the fact that investors may be reluctant to fully embrace this more positive outlook. Why?
I think it's only fair. Over the last 3, 4, 5 years, we've seen several, I guess, false dawns, you could call them, in the North American economy and the global economy more generally.
Yeah.
If you just go back to the beginning of 2014, there seemed to be this broad consensus that yields are about to move sharply higher. It was right after the Federal Reserve had announced they're going to begin tapering their quantitative easing, their purchases of treasuries and MBS. Instead, if you look at where we are today, we're actually at a point where yields are about 100 basis points lower because a lot of the same things that people were concerned about in 2013 and 2012 reemerged in 2014. And here we are today talking about a Greek election coming soon, which is always bound to bring volatility in the Eurozone. So.
Yeah. So what, I guess, for someone who's trying to manage their fixed income, again, we're seeing, I don't want to say green shoots because we've been talking about that for a long time. There's growth happening and we're seeing positive job performance in the States. But what are some strategies that people can do to manage the fixed side of their portfolio?
Right, even though we are in a low yield environment, there are ways to increase yield in your portfolio. One aspect, you could look at extending term, go further out in maturity.
Which comes risk.
It comes with risk, yes it does. You can mitigate that risk by holding your fixed income investment until maturity. Another option, you could go down the credit spectrum. Rather than looking at high grade AA type credit, you could look at BBB type credit, which would give you yield pickup.
And bond laddering too.
Bond laddering is a great tool to use. It takes the guesswork out of where rates are going. Bond laddering, just in case clients aren't aware, simple terms, you'd have 5 bonds, one coming due each year for the next 5 years. When you have the first maturity, you would buy another 5-year bond, so you're always holding a 1 to 5 year maturity. So the longer end allows you to get yield pickup, and then when you're having your shorter bonds come due, hopefully yields are higher at that time when you reinvest and you can take advantage of higher rates.
Let me ask you, Andrew, in terms of outliers or surprises, in 2014, I think some people might be surprised to know that some of the longer bonds actually did well.
Very well.
Are there any in terms of outliers, would you dare say that things to watch for 2015 that could happen?
I think the really interesting thing for 2015 is going to be monetary policy, and particularly in the United States. We've been at a zero interest rate environment for quite some time now. Given the strength we see in the U.S., given how low the unemployment rate is there, again, we can have the conversation about quality of jobs. And the fact that oil prices are lower, while that may be a negative for an economy like Canada's, it's very positive for the United States. Right. The housing market's showing some signs of recovery. Things are just generally better than they have been, as I said. So the question is, will the Federal Reserve decide it's time to lift interest rates off of, essentially 0% or near 0% at the very front end of the curve? The way the global economy reacts to that's going to be very, very interesting.
And the way the markets react to that too. I guess I'm thinking specifically in terms of how the fixed environment will react. I wanted to talk a bit about as well. People are doing some in a search for yield and trying to find some returns for portfolio. They're using proxies for fixed and looking at things like preferreds. What is the good about that to get more yield? The bad?
Right. We see that all the time. Clients looking at preferred shares or higher dividend paying stocks. We just want to remind clients that you have to consider what is your fixed income portion of your portfolio for.
Yeah, and what is it for?
It's to take away the volatility that you would experience with the equity portion. It's your safety net, basically.
Yeah.
It's your capital preservation. And if you're looking at these other items as proxies for fixed income, they don't really fit that criteria.
Right, especially I think when you have outlying events, you just don't know what's going to happen. I just want to wrap things up. I mean, obviously Canadian investors who have bought U.S. equities in the past while or U.S. fixed have done extraordinarily well just on currency return alone. What about unhedged, that is? Now, what about what's your outlook for the currency for 2015?
Well, I think most of the gains that most people expected to see in the U.S. dollar vis-a-vis the Canadian dollar or most other currencies in the whole year of 2015 have already happened.
Yeah.
Having said that, if I just look at the Canadian dollar, with oil prices still very low and likely to remain low for the foreseeable future, and with the U.S. economy looking to be quite a bit stronger than the Canadian economy, there is more scope for the Canadian dollar to depreciate versus U.S. dollar, especially if the Federal Reserve does begin to lift interest rates this year. So we think there's more scope for weakness in the Canadian dollar.
Guys, thanks so much for being here.
Thank you.
Thank you.
Andrew Kelvin, Senior Fixed Income Strategist with TD Securities, and Paul Gray, Director at TD Securities. And I am Kim Parlee. Thanks so much for watching.